Hello and welcome to the Relax, It's Retirement podcast with your host, Josh Leonard, where we talk about transitioning into retirement with intent. I'm Wendy McConnell. Well, hello there, Josh.
Hello, Wendy. How are you today?
I'm good. I've got you all to myself today.
Just one-on-one. We're through tech issues. I think that was like 2 episodes ago. Um, Pete's taking a quick hiatus, and just it's just me and you, Wendy. Just me and
Oh,
you.
it's like old times.
It is. It's a classic rewind here.
Do you want me to sing the song? Just the two of us.
You
We
can, you
can
can.
make it if we try. All right, that's it.
Okay. I just thought that was going to be the episode. Um, we can talk about other timeless things today.
Okay.
Uncertainties like taxes.
Oh, I love taxes. They're my favorite.
That's why I figured it'd just be me and you for this. Your
Okay.
favorite topic, taxes. Um, I it's about that time of the year, so the leaves are falling. It is we're at least finally getting some fall weather. It's been abnormally warm for us. I'm
Yes.
sure it's been kind of the same for you, right?
Yeah. Just about everywhere. It's been very odd. I mean, I'm not complaining, but yeah, it's a little strange.
We were just looking yesterday at Breckenridge. That's where we had stayed when we went out to Colorado to do my bike race. And they have like they have like zip lines and stuff that you can do. And we had done that with the kids one of the days while we were out there. And they had a shot of that area now buried in snow because the ski resorts are open. So I think they're happy for the weather cycle they're getting. But certainly here, it is not a normal fall for us here in Michigan or in Pittsburgh.
Right.
Um, it's
Yes.
been it's been like 80 way too many days. So
So we're at 70 right now here at the Jersey Shore.
yeah. Well, you can go swimming, beach day,
As soon as I'm
November.
done. Yeah.
Yeah.
All right. So what are we going to be focusing on today?
Yeah. So since we're in that fall, whether the weather shows it or not, the leaves are falling. We're going to come up to the end of the year quickly. Before we know it, it's going to be Thanksgiving. We're going to turn the corner into December, and it'll be the year end before we know it. So today we're going to talk through some tax planning tips for the end of the year. We want to make sure that we are thinking through taxes before we're making the turkey and the Christmas ham or whatever holiday food you're eating. I know for us, it is certainly a busy time of the year. So this is a good time to kind of reset, think through the things that we need to get done before the end of the year. And we don't want to miss the opportunity. So although we don't file taxes until April of the following year, there's a lot of opportunities we miss if we don't take advantage before the end of the calendar year.
All right. So let's hear it. What
So
should I be looking at?
yeah, I mean, I think the first one that we talk through a lot with clients is Roth conversions. Does it make sense to take some of your IRA money, pay the taxes on it now, and move it over to a Roth IRA? We would say this is kind of one of the 5 key strategies that you want to look at before the end of the year. Um, for us in our planning system, we did this a lot last week with our fall meeting schedule in Pittsburgh. I was there doing client reviews, and one of the things that we focus on is filling up your current tax brackets. For most of our clients, if they happen to be falling in the 12% tax bracket, we don't really ever think their taxes are going to be much lower than that. So that's not a political statement. It's just, well, you're going to be taxed. And if most of your accounts are in IRAs or 401ks, those are taxable accounts. If you need this much income and you're going to be taken out from an IRA to fill up the difference between that income level and Social Security, you're probably going to be taxed in a certain range each and every year. One of the question marks that we don't know is how much our IRA balance is going to be come RMD age. So for most folks, hitting that threshold here soon, 73, some it might be 75, but at that point they're forced distributions. You don't have a choice but to take it out. Well, if those forced distributions are going to push you up into the 22% tax bracket, it's better off to pay 10% less in tax and pay some of it today. Then that growth from here on out will be tax free. You have to follow certain rules when you do Roth conversions, but for the most part, that's a tax free asset. If you're in that position, where you're going to be forced more than you need to take out, we should start positioning assets to potentially transfer to the next generation as well. So a Roth IRA is better to inherit than an IRA since it is a tax free asset. So Roth conversions are a huge thing to look at. The great thing is once you get that money into that Roth IRA, Wendy, it can continue to grow tax deferred and tax free. So you're not paying taxes along the way or when you distribute it.
What is the most important then thing to consider then? We have to figure out what tax bracket we're currently in and whether we have the tax money to pay for that, what would be considered income if we're flipping it to a Roth.
That's a great point. Having the additional money available can certainly be a plus. Or if in years past you're getting a big refund, you could target increasing your taxable income enough to kind of make that equal. When you do a Roth IRA conversion, you can withhold taxes as well. So if you don't typically get a tax refund, you're pretty good on your withholding, so you're kind of hitting it even every year. And you don't have extra cash before the end of the year to pay the taxes on that. You could convert and withhold taxes in that conversion at whatever tax bracket we're assuming you're going to fall into. I think this really comes into general tax planning too, though. You need to know where you're sitting. If you just say, hey, I don't want to pay taxes in the future, I'm going to take all my money and move it over to a Roth IRA today because these are great accounts. You're going to be in a lot of pain. For one, you're probably going to bump yourself out to the highest possible tax bracket. So you're going to pay at the highest possible tax rate. You're going to increase the cost of your Medicare as well. So your Part B and Part D, like we've talked about on previous episodes, those are based on income. Well, if you do a big Roth conversion, you're bumping your income up quite a bit there. So it really ties into general tax planning. I think it's a common misconception, though, as you brought up, Wendy, that you need to have that cash available. Certainly, you have to pay taxes, but the portion of your IRA, or even if you do your whole IRA account, if it's a smaller individual account, you could withhold the appropriate amount of taxes in that conversion process.
Okay, so that means that basically I'm just using the money in the account to pay the taxes?
Absolutely.
Okay.
Yep. So similar to your paycheck now, while you're working, you've had taxes withheld from your paycheck. So if you're employed by a larger employer on your pay stub, it'll show, hey, deductions for federal, for state tax, maybe withholding for any benefits you have, 401ks, health benefits, all of that.
What does that mean for taxes all around?
Well, Roth conversions are one way to take advantage of space in a tax bracket. Another one could be tax loss harvesting. So if you're in a higher tax situation, maybe you're not thinking about converting money to a Roth IRA, you could look at selling off some stocks. So you could offset some gains in your portfolio by selling some losers. So within the portfolio, if you're looking at a high capital gain from your taxable assets, you could sell some stocks that have been not performing that well, take that loss to help offset some of the gains. This is something that we did a whole episode on a couple months ago where we talked about tax loss harvesting versus tax gain harvesting. So tax gain harvesting is going to bump you up, right? It's going to make more of it potentially taxable. Now, knowing where you sit in the tax brackets, you might be able to harvest a gain without actually paying taxes on it if you're falling into a 0% capital gains tax bracket. This, though, the second one here is tax loss harvesting, where we're using it as a tool to potentially lower your taxes. If we experience any market volatility between now and the end of the year, it might be a great opportunity to sell off something that was hit particularly hard. You don't want to reinvest into that same investment or one substantially similar within 30 days. Otherwise, your loss will be disallowed. You won't be able to claim that on your tax return. So you want to be a little bit careful there. If you sell one stock and you're trying to buy right back into it, you need to wait. But sometimes you can make a lateral move. Maybe you sell a stock, and instead of buying that individual stock back, you could say, hey, I still want to participate in the market. So I could buy something like an S&P 500 fund where you're getting that broad market exposure instead of that individual stock.
Okay.
Another big thing to take care of before the end of the year is your charitable giving. We talk a lot on here about giving and the power of giving, whether that's through your time with volunteering or through your money. Um, if we are looking to lower taxes, charitable giving is always a great way to do that. Many folks have stopped tracking their charitable spending ever since our standard deductions went up during the Trump tax cuts. Those tax cuts are set to expire at the end of next year, and government's going to do what government does. We don't know. There's uncertainty around what would happen to those individual tax cuts, but we do know for now with that higher standard deduction, sometimes it's hard to donate enough to be able to itemize on your tax return. So many folks stopped tracking. If you're over the age of 70 and a half, you can do a qualified charitable distribution. We've talked about QCDs quite a bit. After age 70 and a half, you can give money directly from your IRA to a qualified charity. And by doing so, it's a non taxable event for you. So if you regularly give to your religious establishment or a local pet shelter or a local food bank, if you do that direct from the IRA to that charitable entity, you won't pay any taxes on it. For most folks, they're taking that money, paying taxes on it, putting it into their bank account, and then writing a check back out. By doing so, you have to itemize that on your tax return. So as long as you're over age 70 and a half, just give it direct from the IRA. That can help you.
Okay. Now, does that count toward your income?
No, it does not count
Okay.
towards your income. You do need to indicate that that withdrawal on your tax return was a QCD. Um, so if you use an accountant, make sure to tell your accountant. If you use software like TurboTax or H&R Block has their software, a lot of them have a prompt for how you charitably gave, especially if you're after or if you're older than age 70 and a half.
Okay. Good to know.
If you have a really big tax year too, you can kind of go the other way, Wendy, and give a lot of money and use a donor advised fund as well. So
Okay.
with a contribution through a donor advised fund, uh, you will still need to itemize that deduction, but you can give many years ahead. So maybe if you received a very large bonus or you had some stock options come due or sort of a abnormal event, you could contribute maybe 10 years of charitable giving. If you normally give $6,000 a year and you want to give 10 years, that's $60,000. That's going to bring you well above the standard deduction. You could take that deduction today, hold it in the charitable account, the donor advised fund, let that asset grow, and then give that money out over the next 10 years. I think one of the most magical parts of that is that money can be invested. So over the next 10 years, it should be growing at the same time. Maybe you can even get a full another year or a half a year out of the growth to be able to give even more to the charity. So not only does it benefit you tax wise in a larger tax year, but it can also benefit the charity as well.
Awesome. All right. I like it.
Another one, end of year, maximizing tax deductions for medical expenses. Many of us, I know, for myself, anytime I've needed medical things, it's like, well, end of year, did we reach the deductible? Let's get everything fixed in December, right? There's sort of that year end rush. Um, you know, tax wise, though, so outside of your deductible, any medical expenses that are exceeding 7.5% of your adjusted gross income, you have the ability to deduct there. So if you're thinking about getting something done in January and you have the option in December, you might want to do it in December if you had a lot of other medical expenses this year. Similar to what we just talked about with charitable giving, We want to kind of build up enough to be able to exceed that standard deduction. If we had a lot of other medical expenses, we might be exceeding that 7.5% threshold. So great. Let's try to move forward those medical expenses to take advantage of that during this tax year, if at all possible.
And that's really what it is. It's just taking advantage of it. So, like I think some people feel like, well, it's kind of cheating if no, 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 no. You are taking advantage.
Well, let's talk about timing a little bit here, Wendy. So, my boys have decided that football is important to them. I'm all for it, you know?
Playing or watching?
Both,
Oh
both. The
no.
playing part's a little bit scary when you have a 6 and almost 8-year-old deciding tackle football is the thing to do in the backyard now.
Right.
Um, but they're boys. Boys will be boys. So, but they're in the process of identifying what team. So, I grew up in Pittsburgh. I'm a loyal Steelers fan. Yana grew up in Cleveland, so well, the original Browns are the Ravens. We all know that, but that other new Browns team too. To me, they're very hard to cheer for, but Yana's loyal. Um,
Okay.
Isaac, our youngest, has decided that he's going to be a Lions fan. So, of course, a lot of his friends in school that are from Michigan or maybe their parents grew up in the Detroit area are big Lions fans. And it's kind of easy to be a Lions fan now, right?
Right. Yeah. Come and talk to me after you've gone your whole life without a Super Bowl win.
Right, right. So for me growing up, it was very easy to be a Steelers fan, as you could imagine. And knock on wood, it seems like things are going well this year. But last night, Isaac very much wanted to watch the Lions game, and it was on at like 8:15. So no.
Oh.
So I looked up the score, and it was a close game. They won at the end after trailing. I'm like, oh, we'll pull up the YouTube highlights. He can watch it. And he watched it, and he thought they were going to lose the whole highlight reel because they were trailing the Texans the whole way through. And you know what? All that matters is the timing at the end, right? They
Of
kicked
course.
a field goal with four seconds left, and
Yeah.
were able to win the game.
Yeah.
That's pretty amazing. So Isaac was very excited. It's kind of cool to watch the 13-minute highlights with kids because they watch the whole thing and like you got the whole game.
Right.
You got the full experience. So, just like kicking a field goal to win a game at the end, that timing is absolutely critical for taxes.
I like it. I like the comparison.
Did you like how we got football in there? Do you
I,
want to talk about the Eagles a little bit?
I did. Well, the Eagles won yesterday too, and I watched the Steelers yesterday. So I mean, yeah, it was all
The
about
Steelers
us.
won too.
I know. I
Yeah,
watched it.
yeah.
You're playing. You were playing somebody that I really needed to lose, so I was rooting for you.
You truly were rooting.
So there you go. All right. So don't feel bad about that. It's just good timing.
It's good timing, yeah. And we won't talk about bandwagon fans or anything like that.
Okay.
Yana and I have been really struggling. We're like, well, we'll be. It's kind of logical that you would like the Lions, but it kind of breaks us inside a little bit,
Oh, yeah.
Eli told me he was going to root for Kansas City because they're just really good, and I was like, no. Hashtag wait, Taylor Swift. Taylor Swift.
Well, I do enjoy seeing her outfits at the game.
It's all for the attention, right? We'll just lean into it.
Right.
Anyways, yeah. So medical expenses are something. If you have the ability to maybe move things into this year, get your itemized deductions higher. I would also say make sure you calculate them. We've gone through the exercise with a few clients where, similar to charitable deductions, they haven't really looked at their medical expenses that much. But when you start adding them up, especially if you're lower income now that you've retired, you might actually qualify for that deduction. So it's worth going through the exercise again.
Okay.
This time of the year, too, great. We're in November now. We might be able to realize we're really close. So it might mean, doing checking up with the doctors a little bit more before the end of the year. The last one that we had on the list here is adjusting withholding or estimated payments. So at this point, you probably have a good idea of what your earned income is. If you're looking at your tax documents or a pay stub, you could see how much you've withheld. Uh, like for us, when we're working with a client, we'll plug it into our tax planning software, pull all the different pieces together. What would your capital gains be? What's the interest from the bank? If you inherited any assets, are there any taxes on those assets? Do you need to take an RMD from an inherited IRA? Or all of those pieces, pull it all together and see where you're tracking. Maybe if you've been working one or two jobs, you might not be withholding enough tax or too much tax, in that your tax paid year to date is drastically over or under what you're actually going to owe. So this is a good time to start looking at it and start adjusting that for the year to come. If you know that your situation is going to be different next year, great. Again, let's be proactive there and let's not give Uncle Sam an interest-free loan, right?
Yeah, I'm on board with that.
If you made some substantial changes or had a larger distribution, if you're in retirement from your IRA, maybe you jumped up from that 12% tax bracket up to the 22% tax bracket, but you only withheld 12% taxes. You might be forced to pay an underpayment penalty if you don't get back to track with Uncle Sam here. So it's a good time to kind of reflect on all of your tax activity and make sure that you're not charged anything extra for underpaying your taxes before the end of the year.
Okay.
I would say if you have not scheduled a time to meet with your financial advisor to talk through tax planning, we just covered 5 key areas, but it can make a pretty big difference if you take advantage of these before the end of the year. So I highly encourage you to do so. If you're working with us, certainly give our office a call if we haven't talked recently, and we can check up, make sure that you're still in good shape before the end of the year. These can save you a ton of money, whether it's in tax penalties or by keeping your long-term tax rate as low as possible. So make sure to take advantage of it. In our next episode, we are going to cover know what you owe and own. So not only tracking your debts, but the assets that you have, and have a pretty basic understanding of what you own and why you own it. Many times we'll meet with folks and they don't know why they own certain financial tools. So let's make sure that you're still owning them for a good reason and that you're not pushing debt down the line that you could easily pay off now. If you're new to the show, I'd encourage you to click into the show notes and download our 7 big retirement mistakes checklist. This is a special list that we've put together for listeners of the Relax It's Retirement podcast to help you know if you're on track to retire. So check that out in the show notes. Make sure to download that checklist. If you're not able to check off all the items, or you're making some of those mistakes, make sure to give our office a call and we'll help get you back on track. Until next time, remember to retire with intent so you can live your golden years with the happiness and excitement you deserve.